Guys, this is probably top 2 or 3 least favorite parts of my industry because what interest rates are really based on is really about sentiment and volatility in the market. Or like, why are we lowering rates? If you have a Fed rate cut, generally the mortgage rates will follow. Capital into the system via businesses and people taking out loans. The one thing that people forget, and my industry is horrendous at doing this because they never like saying anything bad about the economy. It's always a great time to buy. It's always best. Everything's always great. Whether you're here in Philly or you're across the country, focusing on that is going to be the only thing you can control. Hey everyone, welcome back to another episode of Moving Sucks. I am your host, Seth, and I am actually going to put this out a little bit later this week. So it's Thursday. I usually do most of my recording on Monday or Tuesday, and I wanted to wait until after the Fed meeting because the Fed meeting usually occurs on Wednesdays, and I wanted to see how interest rates reacted. Guys, this is probably top 2 or 3 least favorite parts of my industry, and the bad information that goes out about rates and the connection that people make to the Fed rate and mortgage rates. So the Fed rate is a broad-based interest rate that affects a lot of different types of investments. It affects savings accounts. It does affect mortgage rates. However, it is not a direct correlation, and my industry is horrendous at explaining this. The mortgage rate is based on the 10-year treasury, and yes, over time they do what we call dance together, meaning they are correlated. But there is a huge energy in the lending and the real estate world to say, well, if rates get cut by Jerome Powell, or Trump's going to lower rates or whatever, that everything's going to become cheaper in terms of buying a house. The last 3 times that the Fed has cut rates, the interest rates have gone up, because what interest rates are really based on is really about sentiment and volatility in the market. And if the market will ask itself, why are we lowering rates? Generally, what these interest rates do and what the Fed does. The Fed has 2 mandates. Okay, Fed will monitor unemployment and inflation, and that's it. The only 2 mandates that they have. They don't care about buyer sentiment. They take all this into account, but there are 2 major metrics that they are tasked with controlling and monitoring: is unemployment or just labor markets, and inflation. And so if the Fed lowers rates, they want to make it cheaper to borrow money. And the reason they do that is because they want to incentivize borrowing. They want to put capital into the system via businesses and people taking out loans. So yes, if you have a Fed rate cut, generally the mortgage rates will fall. And I could show you guys a chart where literally going all the way back in history, they kind of dance along, but they're not like the rate gets cut and then mortgage rates automatically go down, because they are somewhat independent markets, even though in the macro sense they correlate. The one thing that people forget, and my industry is horrendous at doing this because they never like saying anything bad about the economy. It's always a great time to buy. It's always best. Everything's always great, is that they whitewash over the fact that the Fed is lowering rates for a reason. So if they're trying to put more money into the system via people feeling or making money cheaper, making the interest rates on loans cheaper, which is what the Fed fund rate does, they are monitoring a slowdown. So that can be in those 2 buckets, meaning inflation or unemployment. So if they see a lot of unemployment going on, that means that companies are not hiring. And so what they want to do is they want to incentivize businesses to borrow money or to spend money in order to hire those people or take on bigger projects, take out loans for large projects, and by effect would allow that company to hire people, because that would be part of the project costs. The other side of it is if money is slowing down, And we've talked on the podcast about what inflation is before, but if the money is slowing down and the market is cooling, they want to, by the same token, lower rates to make it more advantageous for but business owners and people to borrow money. Now, I'm a business owner outside of being a real estate agent. I have a family business. Very much watching the rates currently because of potential projects that we have coming up 2, 3, 4, 5 years down the road, and we wanted to see what the interest rates would be on a potential loan that we would take out as a company. It's the same thing with a household. If the interest rates are low for a household, it makes money cheaper, and they're more incentivized to take out that loan, or spend down that line of credit. And so, really, what the Fed does is they look at how overheated or cooled the market is, and they adjust this rate to either stimulate the economy or pour cold water on the economy. And so when we came out of COVID, for example, there was this huge spend of money. The government's printed a ton of money, trillions and trillions of dollars, and infused that into the economy. And what that did is everything got ramped up and overheated, and pricing went up. Inflation went up, home prices went up, everything, the price of eggs, the whole political scene was all over the cost of how everything went up. Now, what the Fed has done is kept those high to try to tamp that effect down. There's a lot of differing opinion on exactly whether people should have kept rates high or not. And so now we are seeing, more likely than not, there's going to be more rate cuts to come because the market is now reverting back to kind of a norm. But going back to the topic at hand with real estate, the approach that consumers should take to real estate is that the payment that you have, you should be willing to keep. You should not be buying a house and hoping that rates will drop. You should not be borrowing money and believing somebody who, frankly, is probably wrong 80% of the time, which is no offense to them because economists are wrong all the time. In this environment of information, people can be wrong and people forget about it in 2 hours. So there is a lot of bad information out there. A lot of people just predicting or saying what people want in order to get clicks and attention. And again, we've talked on this podcast before about be careful who you listen to. What's their motive? There's people out there who just want to get clicks and attention, and they know they're not telling the truth, or they know they don't know what they're talking about, but they don't care. They just want the authority that comes with clicks and shares and all that. So we advise our clients to always look at the price of homes, but more importantly, we always look at that payment, because the price of the house actually doesn't matter. And clients are always like, what do you mean by that? Of course it matters. I'm like, no, it doesn't. The thing that really matters is the monthly payment. Now listen, if you're overspending by a gazillion dollars, yeah, of course you don't want to do that. But the payment is the thing that comes every month. The payment is the thing that comes in your mailbox, and you got to figure out how to pay. Now, hopefully everybody who's listening to this podcast is not struggling to pay their mortgage. If you are, that's okay. And we have tools and people you can talk to about that. I am also a short sale and foreclosure expert. So I have been through a few of them, and there's no straight line, but it's better than just defaulting and losing your house and having your credit crushed for several years. But anyway, what we want, though, is to just have good information, and we want to be making decisions based on the information that we want to be making decisions based on information we have right now. Now, do I think interest rates will go down over time? Generally, yes, because I think that the market is kind of had its day during COVID, and now it's just normal that things would kind of come down. Do I think there's going to be a crash? Don't know. Don't really. I think there's a lot of forces that kind of keep that from happening these days. But we should be focusing on the payment today. If you can't budget and make sure that you can get that payment paid and done, if you got a kid on the way, or you're going to be taking a step back from work or whatever, that's what your real estate agent should be talking to you about. Because the last thing that any good, well-meaning realtor wants to do is put you in a house and get a call in 18 months and be like, we got to get out of here. I can't afford this. So my industry, and I started this podcast episode by talking about it, but my industry is really bad at telling people bad or giving people bad news. They don't like doing it. It's always a good time to buy. It's always we'll figure it out and buy the house, date the rate or whatever. And we don't at the SLG, we don't talk about that stuff. Maybe if they ask a question of like, where do you think rates will go? I would answer like, I think they'll generally go down, but we shouldn't worry about that right now. We should focus on that payment is what you can afford, and still do the fun stuff in life and build wealth and, not be worrying about, money all the time. So when you're listening to podcasts, when you're watching TikTok, when you're watching even politicians talk about, how rates are going to come down and it's going to explode and all this demand and prices of homes are going to go up, like all this FOMO language, I would argue that they're not really tuned into how economics are working, and also how this environment is different than COVID. So you lower rates, you might see a little more demand, but it is not going to go back to COVID. And I see a lot of people in my industry talking about the effect of lowering rates. If they get to 5.5, it's going to be COVID all over again and all that. And I don't use those scare tactics because I'm smarter than that. I know that the consumer is in a different place. We have also run through a ton of buyers. We went through in 2.5 years, went through 84% of all like really well qualified super prime borrowers, meaning those are the people who really can transact in any market. So even if we lower rates, it's not going to be this big deluge of people because most of them are in houses already. And the ones that could buy did, and they're in this low rate environment. So the idea of them like selling this house at 2.75%, taking on a 6% or a 5.5% rate, that it does happen. I mean, I'm having my best year ever. There's still people who have to move, but those discretionary moves aren't going to happen. So I just want to caution everybody against the idea that people know what's going to actually happen with interest rates. The last thing I will say that nobody talks about is that when the Fed lowers interest rates, so do savings rates. Your money market, all your savings accounts, those types of interest rates are affected by the Fed rate. So they're indexed against the Fed rate. So you need to think about that when you're celebrating a rate cut. Your interest rate on those accounts will be affected. There's a very, I think, valid theory that if we were to drop rates again, or drop them precipitously, that we would have a lot of people pretty upset who are on the older side, who have their money just kind of in CDs, savings, because they're not going to be making as much money on their money month over month. The theory is that if those rates go too low and those savings rates go too low, then what will happen is that people will start selling their stocks. They'll start liquidating stocks in order to replenish because they can't live off of the interest of their retirement. So there is a lot of nuance to this. If you talk to 100 realtors, there's probably about 97 of them who won't even understand what I just said, or they haven't even heard of it or thought of it or anything like that. Not saying realtors are not smart people, but I think they focus on the wrong thing. And we at the SLG, I talk about this all the time. I talk about economics, and I admit that I don't know everything and I don't know what is going to happen. But the best advice I can give my clients is that we know what the rates are now. And if we lock it in, is that something you can still build wealth with, still live to fight another day, still take the kids on a vacation, buy the wife a nice birthday present, or are you going to be so strapped that you're going to hate me in 6 months when you can't afford anything? So that's what you need to focus on. And whether you're here in Philly or you're across the country, focusing on that is going to be the only thing you can control, and really the wisest way. It's just like any other investment. If you buy a stock and you can't afford to lose it, you shouldn't buy it. You know. So I wanted to give that little piece of advice. Keep just beware of the people who claim to know what exactly is going on. And, I love my colleagues. I love my industry, but this is one where they really missed the mark. So hope you find that helpful, and we'll see you next time. Thanks.